Hello everybody, welcome to Clef Investments. Last time we have talked about how hard it is to beat the market, whether you use value investing or arbitrage. Now let's talk about a key topic. How would I recommend how to invest in stock market? Let's first look at the objectives. So first, my objective is not to beat the market index, but instead just achieving the same performance as the market index. If I do that, I will beat most of the professional money managers, which is good. And this is not a method invented by me. It's recommended by many world-class experts, such as value investor Warren Buffett, or his good friend Edward Thorp, who is expert in arbitrage, or the Vanguard founder John Bogle, who popularized the index fund. And my another objective is to not pay any capital gain tax during my investment method, because as I live in California, the capital gain tax, even if it's long-term type capital gain, it can be almost 40%. So if I can avoid it, I reduced my friction and my investment can grow much better than others who have to pay capital gain tax. And another objective I want is, even when I want to use the money, I don't want to pay a single dime of capital gain tax, which means I have a lot more money available for me to use. Okay, now let's look at the methods. So the method is actually very, very simple. You buy and hold an index ETF or mutual fund. So any broad market index for US stock market would work. For example, the S&P 500 or the total market index. Or if you want, the Nasdaq 100 index also fine. So both are good indexes. They both have different yield, which is how much dividend you get. So S&P 500 or the total market index today get about 1.6% of the dividend every year. And Nasdaq 100 gets less dividend. So if in a certain environment you need less dividend to pay less dividend tax, then Nasdaq 100 becomes more appealing. So we'll talk about that in later sessions. And then, although there's a little bit of the dividend, you want to reinvest this dividend, because as you accumulate all those dividends over the years, historically, you can find that you can actually increase your annual gain by about 2%. So today's yield is very low, it's 1.6%, but actually, if you look at history, it can be higher. So overall, even after you pay the dividend tax, reinvest your dividend, it's still a better idea. And also, use dollar average down, which means when you have some money, like I'm sure you earn money from your salary or ISU, and you have extra money for invest. So when you have money, you buy the stock market index at the current price. So that's dollar average down. It's roughly you use the same amount of dollar to buy stock. If stock market goes lower, you buy more shares, and if your stock market goes higher, you buy less shares. This is very simple to do, but it actually is very hard to do it over the long time. Why? Because you have to fight against your urge to time the market and beat the market. You have to be humble enough, admit that don't try to beat the market. Maybe you feel this is the top of the market, you want to sell, take some profit, wait for a dip, and then you buy again. Don't do that. You cannot predict the market. The dip you are hoping may never come, or when it comes after several months or a year later, the dip is even higher then you buy it now. So don't do it. And also, another problem of this solution is you have to tolerate the very big fluctuation of the stock market over the years. And if you look at the stock value go high and low through the bear market and the bull market, and if you look at it all the time, it's not a good idea. And it can make you feel very nervous about your investment. So the prerequisite, of course, to do this is you need to have your salary to pay your everyday living before you retire. And if you work in the IT industry in the Bay Area, I'm sure this is not a problem for you. Or if you make enough money, then you can be less worried about the fluctuation of the value in the stock. And there's a few more tips I can recommend to you. One is just don't check your account very often. You're not going to do anything about it. You will buy and hold. Okay? So nothing more. You check it, check the price, and figure out how much to buy for your new money. That's it. Don't need to check it often. Doesn't help. Or actually, if there's a bear market, when stock drops, you should be happier because now you can buy more. And know that when you retire, you get more shares and this will grow more for you. So this is another tip. And when we talk about tax harvesting in future session, you know why you really, really hope stocks drop. Okay, now let's look at, in the end, after you retire, how to avoid the capital gain tax. Now you need the money, but you don't want to pay tax. And the solution is also easy. If you sell, you pay tax. So my solution is I never sell. I really mean never. Because even if I die, I don't want to sell. So how do I use money? Well, you borrow against your stock. So it's a form of stock-backed loan. And if you borrow, you pay interest, but you don't pay capital gain tax, ever. And when I pass away, when I pass this to my children and my estate, the cost basis of my stock will have the step-up rule, so that after I pay estate tax, I no longer need to pay the capital gain tax. And we will talk about estate tax later. But again, I'm not paying capital gain tax here. And this method is not invented by me. It's called buy, borrow, die. You search this on the website, you can find more descriptions about it. And it's a common way that rich people how avoid tax and increase their earnings. So let's now look at a concrete example of sale. We compare, you sell the stock, pay the tax, versus you borrow against your stock. So I'm assuming the stock doubles every 10 years. That means roughly every year it appreciates about 7.17%. Okay, so now let's look at the table, the leftmost column. Assume you start with $1 million and you want to hold it for 30 years. After 30 years, it doubles every 10 years. So it will become 248. So it's supposed to become $8 million after 30 years. But you need money. So there are three scenarios, whether you want to use $100,000, $150,000, or $200,000. Three scenarios in each rule. So let's look at the second column, sell. So this is the simplest method. You sell and pay tax 38.2%. And now you have 1 million minus 100K, and you sell. And then after 30 years, how much money you have? You have $6.7 million, not 8. And if you sell more and use more money up front, you get less money left. Okay, you get 6 or 5.37. But if you can borrow and pay some interest. Assume we pay interest of 3% on the third column. With $100K, you will, in the end, you get 7.8 million, which is very close to the $8 million if you didn't use anything. So this is 16% better than you sell and pay tax. And the more you borrow, the more in the end you get compared to you sell and pay tax. So what if the interest rate goes higher? Of course, you get less money because all the interest rate also compound every year, actually every month. And you get less money left, but they still beat the stock, the second column where you sell and pay tax directly. What if the interest to borrow is very high? That's like 7.17%, which is the same as how much your stock appreciate every year, 7.17%. Well, you still get more money left. You get 7.2% million or 6.4 million if you borrow that much, but it's still like 7.4% or to 18% better than you sell. So why, if the interest rate is so high, you still get benefit? This is because the tax, you avoid paying the tax. So you pay interest, but the tax dollar, you are losing it if you sell. And here, you don't lose the tax. So the tax money will grow, and in the end, it becomes a very sizable gain compared to you pay tax upfront. And what if the interest rate is so high, it's 9%? What would you do? In that case, pay the interest and borrow, it's only marginally worse compared to sell it and pay tax upfront. And it's very rare, or maybe never happened before, that the interest rate is so high for 30 years. So this is very, very unlikely to happen. And if you're interested in how I come up with this calculation, you can open this spreadsheet, Google Sheet, to check. Okay. So now let's touch a little bit more about borrowing against stocks. So remember, if you're borrowing money against stocks, you increased your leverage. And leverage has both risks. It's a upside risk benefit of getting more money, and the downside risk. So I would recommend you to not borrow too much. Maybe you can borrow up to 15% of the stock, so that the stock index has to drop more than 80% to put the risk to your account. But of course, before it drops that much, maybe you should do something else. We can talk about that later. But anyway, don't borrow too much, because there's a risk that your stock account get wiped out if you borrow too much. And if you have your company RSU, a very concentrated stock, then it's a much higher risk. So you should try to convert them to stock index, and then you can borrow against the stock index. I do not recommend borrowing against a single stock. That's too much risk. And how to borrow? There are many methods we will discuss later. But ideally, I want a very low interest rate. For example, only slightly higher than the interest rate that US government borrows money. And I do want all my interest to be capital loss, so that with this capital loss, you can sell some of your stocks to reduce risks, and tax-free, because when you sell those stocks, the capital gain can cancel out the capital loss. So we'll talk about that later in future sessions. And this is all for today, and let's see you next time. Thank you.